Special report about interest rates. I'm Rich Pass for Critical Point. It is January 12th, 2025. Okay, what we have is a development here on the long-term trends and business cycles of interest rates, bond market, and a development here that might be problematic for the stock market this year when we've been quite bullish and done very, very well and for the past several years. At any rate, what I want to point out is this is the 10-year Treasury note monthly chart, and it's showing us with these green bars of how far it traveled, what did it do for a month. Notice how strong the up move. Some chart people would say this pattern right in here was a bearish pattern, ought to have gone down. Well, it turned out the business cycle correctly called a super cycle bottom back in 2020. I called it in August. That was the bottom month. That's how close we were. And I said interest rates are going higher this decade and may go higher over coming decades, but I believe we're going to see at least one recession per decade that will possibly pull it all the way back down. So I don't want to scare people into thinking we got super high interest rates over several decades. It doesn't have to do that, okay? Probably not heading back to 20% interest rates like in 1980 or whatever. But at any rate, we correctly called some of these twists and turns, this bull run here, all right? And we were all set for lower interest rates to come down and had hoped it might even come down to 3%. But now the model's raising some of the lowest of downside potential or targets, saying it won't drop as much for interest rates. In addition, the model is saying this is quite strong, and we correctly forecast the bottom and the up move. We forecast in between correctly, so that's working very well. But relative to what should be a type of sell signal in interest rates, if you will, a top, okay, that type only occurs maybe twice a decade at the most, okay? And it should have really worked down like this. And I'm fine with sideways as well. But this strength is rather bothersome that what else is going on? And I think what we're doing is the market is shifted into following Maganomics of saying that and the surge in federal debt that's being printed and pumped out there, which may be actual money printing, which is probably helping the economy. If it's not true money printing, then it is just federal debt. But that's bothering the market. The market is saying it needs a higher interest rate to entice investors to purchase that new debt, okay? And it's not just the federal government, but the private sector also is on the high side of debt, all right? So this is just a function of a good economy, other than we have the Maganomics adding on to it that is bothering the market, that especially if we have tariffs, we can have higher inflation, which means we're going to need higher interest rates. So the bond market is basically putting interest rates up ahead of time just in case, all right? So we've got layer on top of layer on top of layer of a multifaceted story that is net bullish, and the market is really going for it, making it very bullish on interest rates, very bearish on bond prices. So the model is saying, even though it should pull back into a similar bottom as we just seen for a top, that it now is unlikely to pull down as low as expected, and it may not even work. What the model is more concerned of is once it puts that bottom in, it should go up into a top, and the top will be a little bit different. It's minor long-term. It occurs 4, 5, 6 times a decade of when you would buy bonds and basically bet on the downside of interest rates, okay? What the model is saying is a good possibility this pullback in this bottom just isn't going to work. It doesn't matter. It just wants to go higher. And it can go higher into October of this year to October of next year, basically a 12-month, 13-month window to find the next top, okay? Now, what's concerning is the market is so close to the prior high, and the model is saying it cannot find a reason why it would top now and be a very important top, and there's nothing to worry about in terms of if you don't like higher interest rates, okay? And the stock market generally doesn't like higher interest rates, all right? Being so close, what the model is warning now, if interest rates of the 10-year Treasury note move above 4.98%, then the model's saying we ought to have higher still interest rates from October of this year into October of next. It might top as soon as October this year, over and done with. It might come down, fake us out, put it right back up and higher still a few times, and it's all over next year and finally comes down. Okay, so that's what the model is warning that could occur. We may get a signal ought to go higher. Now, in addition, the model is saying if we use various techniques to calculate how far interest rates are going within a trend, this trend right here, there's a possibility rates are going to go above 4.98 to this target, stay below 5.5, move to just a little higher, and a new high for the decade. Okay? And then we'll reevaluate. We might get a setback then, but the problem is later on, it could go higher still into that long-term target. Well, how high can it go? Well, using this setback and running a calculation that if it goes above 4.98, we're going to start considering about 6 to 6.5%. And what's concerning to me is going to that level this year, I think might be too fast, too much, and it's going to cause economic problems. And it can cause problems to the stock market and other financial sectors, okay? And what could drive that? Well, it could be the tariffs and inflation that make interest rates go higher still. There may be some other lesser important factors that could make it occur, all right? Now, so we're going to leave it at that. That we want to watch 4.98%. That's the most important thing to watch for the moment. And realize if it goes above that, there's a chance there will be higher interest rates by October on into next year. There's a chance interest rates could go to 6.5%, and I'm afraid that's not going to be a good thing. All right. And in the meantime, even if it goes through 4.98, we might see it stall out or stall below 5.5%. It might back off quite a bit into this bottom we're looking for, but it just won't come down as much as we'd like, not as long as we'd like. And it's just because the market is in a more serious up move going into the end of this year, perhaps into next year. And I think this has to do more with Maganomics than it does with just where we're at right today with our economy. But there's no question about it, the bond market is concerned. We're printing a lot of debt even right now and have printed it last year. That can be a problem as well. So this special report is all about watching 4.98%. Goes above it, we have to be concerned of higher still and problems all the way into the end of the year on into next year for our economy. Doesn't have to be a serious problem, but the faster and higher interest rates go, the more likely people will be nervous. Something's going to break, you're going to hurt the economy and fall into a recession. And if we have inflation to help drive that, yes, that's one way of also killing inflation, but it could backfire and then send us into a recession as well. For the moment, right today, good economy to great economy. We've had a good stock market, and if you're following my updates on the stock market, you know I'm already forecasting. We may have problems now to October for the stock market. And the problems, we may get over them quickly and still have record highs, okay? And we can still even have a good stock market with some of this Maganomics problems that we're going to get. Lots of twists and turns, tipsy-turvy stuff we're going to deal with in coming years here, in coming months. But at any rate, right today, at least for the interest rate, very, very interesting development that I didn't think we'd be seeing, but it always had been on the table, and now we're saying now we got to move it from actually a shelf to putting it on the table. It's not yet front and center, but if those interest rates want to go above 4.98, then we need to have additional discussion here. Where are we going for the future for our economy, inflation, interest rates, business, and the stock market? I'm Rich Pawson. Thank you. Go to criticalpointpod.com or criticalpoint.podbean.com if you're not a subscriber. Thank you.